Hello everyone, my name is Radovan Vojtko, I'm CEO and Head of Research at Quantpedia. This video will be a little special. I would like to show you how to use Quantpedia to build a better portfolio which is better suited for bear markets. So we are currently in April 2025 and most of the equity indexes all around the world are in the bear market. So the bear market was started approximately a month ago by Donald Trump by the recent imposition of global tariffs. And it has triggered a sharp and sudden sell-off across all of the equity markets. In times like this, it's natural for panic to set in, but however, we are quantitative investors or quantitative traders, and so our strength lies in the data-driven decision making. So what does it mean is that we can employ better risk management and we can maintain discipline. How can Quantpedia help you with that? So we have a list of the tools that can help you, and we wrote a short article about them, and I will guide you through that article, and I will show you directly in Quantpedia webpage how you can use these tools. Firstly, what is probably the most important is to screen for crisis hedge strategies. So when you have a portfolio, you can have a lot of the different types of strategies in your portfolio, and there are strategies that perform well in a crisis, and those strategies are usually called crisis hedge strategies, and you can easily screen for them in our Quantpedia screener. So here you can add the filter. You can find a filter called crisis hedge, and you can find strategies that are crisis hedge. So if I press here yes, then the filter will filter the strategies for that are crisis hedge. So we have around 150 strategies in our database, so it's 15% of the database that can act as a crisis hedge. What is the crisis hedge strategy? As once again is a strategy that you can use very easily, implement it into your portfolio, and usually it performs very well in a crisis period.
Unlock the power of Quantpedia Pro with over 900 premium strategies extracted from 100,000 research papers and more than 30 quant reports. Model full portfolios, generate real-time reports and save hours of work. Quantpedia Pro, your edge in quantitative investing.
How do we look for those strategies? We read the papers that are source papers for those strategies, and one of the key criteria we assess is the performance of the strategy during the equity market downturns, and the best strategies in which the researchers wrote that they perform well, they showed the performance during the crisis, or they showed the correlation that the strategies have a negative correlation. The strategies for which the paper demonstrates that they have a positive return during the crisis are flagged as a crisis hedge, and they are entered into our database. So this is the way how you can easily find those strategies and you can implement them in your portfolio. Okay, so this is the step number one you can do. The step number two, so what we are doing is that we are not just looking for papers and writing about interesting strategies, we are also backtesting those strategies. And once we have a backtest, we can measure what is the correlation of the strategy against the market. What we can do is I will now turn this filter off and I will show another filter. So there is a filter called correlation. Once again, you can go to out of sample backtest, and here in out of sample backtest you can filter all of the strategies we have in the database using various fields. And here we have a field correlation, and this field correlation shows you what is the correlation of the strategy to overall equity market. So I can select only the strategies which have the negative correlation. So what does it mean is that those strategies usually perform well when the equity market is not performing well, and once again they are a good addition to the overall portfolio and they can increase the diversification and make your portfolio better. I can select the strategies with the correlation 0 and less. And once again, we have, around 150 strategies, and those strategies are once again built from scratch. So we coded those strategies and we calculated the correlation to the equity market based on the out of sample backtest. So you can check the strategies, you can try to find out those that are interesting for you and have a nice performance over the last 3 months or last month. Okay, so this is also the idea. You can sort the strategies by year-to-date performance, and it will help you to identify those that have weathered the current market turmoil pretty well. So here I can change the out of sample return stats, and here I can sort the strategy based on the year-to-date performance. So I can sort them from the best to the worst, and here I have strategies with the correlation which have the correlation 0 or under and have significantly positive performance over the last 3 months, so year-to-date performance. As you can see, there are a lot of them, and you can add them to portfolio portfolio, and they will work as a hedge in current times. Okay, let's move on. The point number 3, alternative filters. So how to find resilient tactical models. I have shown you how to sort the strategies based on the year-to-date performance. I will remove the correlation filter, and let's imagine that I run a fund, and the fund is asset allocation fund and is running multiple tactical asset allocation models. I would like to see how my tactical asset allocation models perform compared to the strategies that are in Quantpedia. So how we can do that? So I can go to the keyword filter. I can find the asset class picking. Those are the strategies that are tactical asset allocation strategies. So I can select just those, and I can sort them based on year-to-date performance. And here we can see what are the tactical asset allocation strategies that perform the best over the last 3 months. So it's over the time when the equity markets did not perform very well. What are the best performing one? As we can see, strategies that are performing the best are those that usually contain gold. So one of those is for example, pragmatic asset allocation model, which is our own model, which had really nice performance year to date, over 8%. The reason for that was because the model is long the gold, and as we can see, we are not able to see the current crisis at all in the performance of the model. And there are a lot of the other models that have the gold, or they are long treasuries, or they hedge going short the equity market, or they hedge the tactical asset allocation portfolio by going long volatility ETFs, etc., etc. So there are a lot of the ways how you can build a tactical asset allocation model which performs relatively well even in the crisis period. So let's move on to the point number 4. So what we can do in current situation is we can stress test our portfolio with the historical shocks. The Quantpedia tools are not just screener. You can also use the portfolio analysis. In a portfolio analysis tool, you can build any portfolio that consists of your custom equity curves, or Quantpedia strategies, or some ETFs. You can analyze the portfolio performance, factor exposures, correlations, market risk, etc., etc. So in this case, I selected the portfolio and it consists just of equities. It has only the one ETF, SPI ETF, so S&P 500 ETF. So this is our portfolio. We can check what is the performance of the portfolio. So I can click on the basic overview, and the basic overview report will show me what is the performance over the whole period, what is the performance over the individual months, what is the drawdown, etc., etc. So it will calculate, it will show me the equity curve, it will show me annual performance, it will show me the monthly performance, rolling beta, performance consistency, etc., etc. And what is interesting, or what I can look, is I can check out the historical shocks. How does it work like? So here we have a 1-day shocks and 100 years historical events report. So how does this report look like? We will take your portfolio and we will use our own methodology, and we will find what are the factors that can explain your portfolio the most. And we have the history for over 100 years for around 30 market factors. So we will build a synthetic portfolio from your portfolio, and we will try to find out how would hypothetical portfolio that you currently have performed over the crisis periods that happened over the last 100 years. So the worst 1-day shocks and the biggest geopolitical events of the past century. What does it mean? So for example, we can take a look what was the performance, what is the usual performance several days after the shock. So when there is a geopolitical shock, you can check out what is the average performance of the equity portfolio during that geopolitical shock. So it's around 8% or -7, -8%. And then we can check out what is the 90 percentile. So what is the best case scenario after that shock, and what is the worst case scenario, so what is the 10 percentile, so how can your portfolio perform over the time after the shock, 1 day, 3 days, 5 days, 10 days after the shock. So what you can see is that in the best case shocks, as were in the past 2 or 3 or 5 days, they tend to get better in approximately 10 days if we are lucky, and if we are not lucky, we can end up in the bear market, and in this bear market you can lose around additional 15%. So average bear market after the geopolitical shock or after the 1-day shock, like -5%, ends up at around day -10, and the maximum run is around -20%. So that's the average 1-day shock in the equity. So how does the performance look like? And then we can check how does the performance look like the 1 week after the shock or 1 month after the shock, and how long does it take to recover from these events. Usually it takes around 2 weeks to recover from this shock, but if we are not lucky and we enter the significant bear market, it can take from 1 year till up until until 5 years. Those are the numbers. We will see how it will look like over this bear market. Let's move on. That was the point number 4, and we can move to point number 5. So what we can do is we can analyze the performance in the current macroeconomic condition. So once again, we can select our portfolio, so we can build the portfolio. Here I will change the portfolio, so I will change the portfolio. I will not just have the equities, but I will add treasury bonds. So I will add 7 to 10 year treasury bonds into the portfolio. I will change the portfolio to have 60% equities and 40% treasury bonds. So this is like usual 60-40 portfolio. So I have a portfolio that is 60-40, and I would like to check in a portfolio analysis section how my portfolio usually performs over the bear market, over the 100-year history, and what are the other asset classes that perform well, and what are the other asset classes that do not perform so well over the bear market. So I can go here, 100 years market state regime analysis. Once again, what will this report do? So we will replicate the selected model portfolio. The selected model portfolio starts in 2002 because that's the year when youngest ETF in our portfolio has an inception date, so in 2002. But we would like to see how the portfolio behaves over the longer history. So we will select the model portfolio, we will calculate the underlying explanative factors, and we will extend the portfolio history to 100 years. And then we will check out how it performs in all market states. We can check out not how it performs just in bear markets, but also in the bull market. So here we have our synthetic portfolio that's built from historic portfolio. So we extended the history of the portfolio to 1920s, and we can see where are the bear markets. So the bear markets are red one, and we can see bull markets. The bull markets are the green one, and here you can see what is the usual performance of the portfolio in the bull market, what is the volatility, what is the Sharpe ratio, and we can check what is the portfolio performance in the bear market, and we can compare that portfolio performance to other factors. So what we can see here is that our model portfolio that consists of 60% equities and 40% bonds over the course of the whole bear market usually gains just around 1%. What are the other assets that we can add into our portfolio to have the better performance? It's mainly the long bonds or the healthcare stable defensive equity sectors. So we can move our portfolio and we can buy more healthcare, or we can buy trend following, and it will help us our portfolio to have a better performance. If we expect higher inflation, we can check our portfolio performs in higher inflation, our portfolio performs in low inflation, in rising rates environment, in decreasing yields environment, etc., etc. So there are like multiple different macroeconomic regimes that we can check. So that was point number 5. Let's move on to point number 6. So the point number 6 helps you to find crisis hedge ETFs or crisis hedge strategies that you can add into your portfolio during the crisis. I showed you a few minutes ago that there is a screener filter and you can screen for the crisis hedge strategies, but as I mentioned before, we have around 150 of them in our database, so you can screen through all of them automatically. So once you have a portfolio, you can go to crisis risk management section, you can go to crisis hedge strategies report, and you can run the crisis hedge strategies report. And what the report will do for you, it will automatically go through all of the strategies in our database, and it will try to find those that work as a crisis hedge. The crisis is defined differently, so there are 2 definitions of the crisis. The first one is we will look when your portfolio has a negative month, and we will try to find those strategies that perform well in the negative month. And another one is we will identify when there is a bear market in your portfolio, and we will try to find those strategies that perform well in a bear market. So there are like 2 different ways how you can find crisis strategies for your portfolio. So here you have the portfolio, here we have a negative months in the portfolio. Here we can see what is the performance over those negative months. So on average, your portfolio loses around -2.5%, and the worst case is around -4% in those negative months. Here are some ideas what you can add into your portfolio. So what are the strategies that can work very well? So those are the strategies that have negative correlation, and on average they have the positive return over the months when your portfolio has a negative return. So what are the strategies that are the best? You can add turnaround Tuesday effect, you can add depth growth effect, you can enhance your portfolio using betting against the beta strategy, or you can add the lottery effect strategy into your portfolio. There are also the ETFs that you can add into your portfolio. So you can add some short S&P 500 ETF, or you can add many futures, or you can add US dollar. So even the US dollar can work very well as a hedge. So long US dollar position can work very well as a hedge for your portfolio. Let's move on. point number 7. So we are in a crisis period at the moment, but most of the investment professionals recommend to take advantage of the market corrections and how to take advantage so you can gradually invest more into the portfolio, so we can perform gradual reinvestment. And what is the best way? The best way is to use the dollar cost averaging. So we gradually invest more and more into the underlying portfolio as the portfolio loses the value, because sooner or later the equities will turn and we will once again enter the bull market. So it means that we can buy the equities cheaper at the moment. So what we have is a report called dollar cost averaging, and this report simulates how various gradual investment strategies would have fared during the past crisis. So it will allow you to test different approaches for allocating capital into the falling market. So once again, let's move to our set of tools. We have a portfolio that consists 60% of equities, 40% of treasury bonds, and we would like to check how dollar costing would work. So for something like that, we can select some crisis period. So we can start with the crisis period, some last crisis. So from December 2007, we can select the end date, let's say December 2011. So that was the 4-year period, which was really not very good for the equities. So here we have a 4-year period, and once we have selected 4-year period, we have multiple different strategies how to invest into the falling market. So strategy 0, invest gradually over the whole 4 years. Then strategy number 1, invest periodically during the first half of the period, and then holds the entire investment to the end of the period. The strategy number 2, invest periodically during the first half of the period, and then it divests, so it sells when the market starts to go up. And the strategy number 3, invest periodically during the first third of the period, then it holds for the next 1/3 of the period, and then in the last 1/3 it divests on a monthly basis. So we can check out how all 4 strategies would perform, which one is the best when we are entering the bear market. Here is the lump sum investment, how it will look like if we invest the whole sum of the money at the beginning, so before the bear market. And then we can see all of the individual strategies. We can see that the best approach is probably the strategy number 1 or strategy number 3. So the strategy number 1, it periodically invests during the first half of the period. So you are investing in the first half, then you are just holding investments that you have. Strategy number 3, that periodically invests into the bear market, and then once bear market turns and starts go up, you periodically sells. So this is how you can very easily simulate how to invest the money into the falling market. So I hope that you liked all 7 points that I showed you. What was the main goal of this video was to show you that even when there is a sudden market shock or there is some geopolitical upheaval, we are the quantitative investors, so we are not powerless. We can have the right tools, and we have a data-driven mindset. We can adapt, we can protect, and we can even find opportunity. I hope that you like the tools that I showed to you, from strategy screening to portfolio stress testing. Feel free to check out other tools in the Quantpedia, and I hope that you will join me in the next video.